In this week's video, we'll review the latest charts to help us answer the question, stocks, a fantastic entry point or just another failed rally attempt? Got a lot to cover. Feel free to use the pause button on your video player. If institutions felt that the Fed had pivoted and institutions were confident that interest rates had peaked and institutions were confident that inflation had peaked, it's probably not likely that our full week numbers would look like this. S&P, NASDAQ 100, Dow Jones Composite, ARKK, Triple Qs, NASDAQ Composite, SPY divided by IEF, all of them down for the week. The only bright spot, defensive IEF. Now that move in IEF does tell us to keep an open mind about a bottoming process because it speaks to interest rates. It's Friday afternoon, July 15th at 3:22 p.m. Eastern Time. A good way to look at a trend objectively is to look at it and think that you were taking a multiple choice test. If we saw this chart of the S&P 500 and were asked, is this an uptrend or a downtrend? It'd be pretty easy. We would check downtrend and we would move on to the next question. When the market closed on Thursday, you can see this DeMark chart, and DeMark charts and indicators are proprietary tools from Market Studies LLC. You can see there was an upside propulsion target here at 38.76. And when you see that as of Thursday's close, your thought is, if we move up there, it's really not going to have any effect on this chart in any meaningful way. This would be a lower high relative to this high, and this high is a lower high relative to this high. And then we still have this gap to try to get through here and another gap up here. So while Friday's session is impressive on many fronts, there's really not a lot of improvement on this chart. Also noteworthy, the downside propulsion magnet is roughly 10% below where we are now. Doesn't mean we're going down here. It's just simply a reference point. If you're a stock market bull, you'd really like to see this high exceeded, which may happen, hasn't happened yet, 39.45. And maybe more importantly, you'd like to get to the other side of this gap. The lower portion of the gap is 40.17. This chart may improve significantly very, very soon, but it hasn't improved yet. Covered this topic in detail last week. Market expectations are currently for the Fed to start cutting rates early next year. As we discussed last week, that may change in the coming weeks and months based on history. The exact same case is made in a series of tweets that you can find on Twitter. And rather than pivoting on Friday, Bullard said he thought rates would have to go higher before year end. Loretta Mester said we'd be moving at least 75 basis points at the next meeting, which would be one of the largest hikes in Fed history. According to Bloomberg on July 15th, the Fed has indeed pivoted recently. They've pivoted aggressively to fighting inflation. So as of the close on Friday, July 15th, do we have data in hand making a strong case that inflation is under control? Several Fed governors came out after CPI and said the answer to this question is no. Has the Fed pivoted in a meaningful manner? Just went over that. The answer is no. And we'll cover this in the remainder of the video. This portion of the video is being recorded at 3:50 p.m. Eastern Time on Friday, July 15th. Here's the S&P 500 score from June 24th. We'll provide an update as of Friday's session during the video. Many of the charts that follow were covered in a session that was recorded on Thursday evening. We're going to walk through them quickly so you have a reference point. No significant change to this chart. This is during Friday's session, basically flat for the week. All of these charts are during Friday's session. No significant change to the commentary that follows when you see this chart. With about 25 minutes to go in the session on Friday, the NASDAQ was still down 1.85%. Dow Jones Composite, the commentary that follows is still accurate, also down for the week, late in Friday's session. No material change to this chart. This is as of 3:36 p.m. Eastern Time. Why is that most likely the case? This is the 150-day moving average here for the NASDAQ 100. You can see we're nowhere near it. So it's going to be very, very difficult to get a thrust like this. How does a thrust like this happen? After a period of consolidation and sideways movement. No significant change on this chart, down 1.63% for the week as of 3:38 p.m. on Friday. No change here, 3:38 p.m. Friday. Commentary will follow. ARK Innovation ETF with about 20 minutes to go. Rejected here in a downtrend. Rejected here this week. Still down 6.19%. Score on our bottoming process model on Wednesday of this week was only 5.5%. ARK versus defensive staples, pretty much in no man's land here. Some good things, but no breakout yet. High yield bonds, when we talk about it, still far away from the trend line during Friday's session. Talk about this chart later. Here's a version during Friday's session. It looks the same. Concepts here. This is the same chart for the S&P 500. This is possibly one of the most encouraging charts that we will cover this week. Corporate bonds late in Friday's session up for the week. Sometimes the credit markets will bottom either in unison with the stock market or before. In this case, well before in Q4 of 2008. In this case, basically at the same time the S&P bottoms. If you're a bull, you'd like to see this up 1.28% for the week. Still needs to break the trend line and move in this direction. Remember, for clients, we're trying to determine, do we want to put additional capital in harm's way? QQQ divided by SPY late in Friday's session. The answer here is no. Down 0.29% for the week. Like to see this ratio get into this area here. SPY AGG, we cover it later. Late in Friday's session, down 2% for the week. When you see this chart later in the video, just be aware it's down 1.1% late in Friday's session. No change. SPY late in the session, no change to the commentary that follows. Here's the rally on Friday. We do have some additional upside before we would challenge this trend line hypothetically. Cover this in detail later. Just want you to know, no discernible change. Still up for the week late in Friday's session, up 1.1%. This portion of the video is being recorded on Thursday evening, July 14th. Some good things happened in the stock market on Thursday, July 14th. For example, tech stocks rallied sharply. And thus, based on some of the data that we had in hand on Thursday, could have made the case that market action looked pretty good. Now we're looking at a chart of the S&P 500, full year 2008. We also could have said between point A and point B that market action looked pretty good, between point A and point B, and between point A and point B. Good things happening within the context of a downtrend is not really particularly abnormal. This trailing PE for the S&P 500 index as of the close on Thursday, July 14th, the figure is 19.16. If we go back to the low in 2009, when the market bottomed during corrections, the average PE was 17.5. Thus, if we had a contraction from 19.16, the current level, down to 17.5, that implies an S&P 500 drop of approximately 8.66% from July 14 levels. Hypothetically, that would take you down to 3462 on the S&P 500. From a bear market perspective, PE levels at lows tend to get much lower than this. So even using this somewhat tepid standard or easy standard here, valuations are still relatively high. NYSE Bullish Percent Index. This is your breath thrust look off of the COVID low. We do have an oversold look, but this is a really tepid turn here on the last rally in the S&P 500. Compare this look here to this look here when the S&P popped here, and this look here when the S&P popped here. Similar situation with the S&P 500 Bullish Percent Index. We are down at levels that tell us to keep an open mind about a bottoming process, but we don't have anything thus far that looks like a breath thrust. That may happen very, very soon, but it hasn't happened yet. Also noteworthy, the recent low here 2008, we were not nearly done with the bear market. This is Q4 of 2008. The S&P 500 had quite a bit further to fall into March of 2009. That would be the concerning case. The good news case would be here, Christmas Eve 2018. We bottomed. But notice what happened after that. A very strong thrust. It's important to note, this thrust here is also associated with a very, very clear Fed pivot that occurred in the first 10 calendar days of January 2019. Bitcoin relative to the US dollar. Long period of consolidation. We get the breakout. Full bore bullish look in here. Really just the opposite up here. Long period of consolidation. A bearish breakdown with a full bore bearish look. Right here on a daily chart, you could have said the market needs to consolidate its gains. So this little piece in here, this little blip on the radar, this pause here for several weeks, is consolidating this move here. So this is a continuation pattern within the context of an existing uptrend. You pause, market consolidates its gains, and then you move higher. Thus, it's possible that this look here is the same thing. The market needs to consolidate its losses, and then we're going to move in this direction. That would be the base case right now. Why? Because we're clearly in a downtrend, like all the charts we're going to cover in this segment. This chart may improve, but it really hasn't shown material improvement yet. Also noteworthy, we've been consolidating under the 200-week moving average shown in red. It's the NASDAQ composite as of the close on Thursday. Down here, we're looking at the NASDAQ divided by the S&P 500. Hit the trend line, the ratio falls. Hit the trend line, the ratio falls. We're moving back towards that trend line, and thus we'll learn something in this area here. If we look at the same ratio here, you can see when we hit the trend line right here, which is this point here, the S&P 500 was already falling, and then it continued to fall. So if you're a stock market bull, what you want to see is step one. You want a break of this trend line, and then you want to go on to make a series of higher highs and higher lows. Right now, this does look a little bit better than this. Why? Because this is a nice steady move off the low. It might have a better shot of breaking this trend line, but right now, the ratio is clearly in a downtrend. Price is in this area of congestion in the land of gaps. So like this down here, we'll learn something if price moves into this area here, or if it can move out in this direction here. Common sense tells us this is an important area, and you can see volume by price. A little bit of an air pocket above us from a bullish perspective, and then a lot of concern below us relative to volume if we break this area here. Indecisive at the moment. We know we want to keep an open mind about a wide range of outcomes. Very, very possible that the secular trend holds and we get a bounce here similar to the COVID bounce. It's also possible that we're bouncing here similar to the dot-com bust, and then we're going to move in this direction. Financial crisis, we hung around the 200-week for several weeks, if not several months in here, and then we plunged. You can see PPO momentum here. The only two times it's been that bad, right here, bear market wasn't over, and right here, the bear market was far from over. No predictions. This still could go either way since we have this potential support here. Let's call this anecdotal evidence. You can see the German DAX holds here in 2003. It holds here in 2009. Held in the same general vicinity in 2020, and those coincided with major lows in the S&P 500. This is a retest in 2003, and then stocks went higher. This is very, very close to the major low in March of 2009 in the S&P 500, and this point here is very, very close to the COVID low in 2020. If the pattern were to hold, and that's to be determined, even if it holds, it implies further downside in the DAX to get into this area here. The bullish scenario, would be to retake these levels up here. So this is a bullish breakout. Now it looks like a failed breakout. Dow Jones Composite Weekly. This is a multi-sector index, unlike the Dow Jones Industrials. This weekly gap up here was never revisited on a weekly basis relative to the close on the daily chart on July 14th. Getting into this gap here would represent hypothetically a drop of 7.53%. To get into this COVID gap down here, that's 8.9% hypothetically. Lower right-hand corner of your screen, weekly momentum, really nothing encouraging now. We're below the center line. That tells us from a probability perspective that we're in a weekly downtrend similar to this point here in 2020, and this shallow, relatively shallow move in momentum here in 2018. This is a weekly chart. Also got an unfilled gap here, a gap up on the daily chart. Not forecasting anything, it's just good to know that that's 11.59% below the closing level on July 14th. Keep in mind, even if this gap is eventually filled, it doesn't mean we have to come down to this area anytime soon. We could get a counter trend rally into this area of possible resistance, and it's also possible that this gap never gets filled. It's simply a reference point. Travel and Tourism Index, we've been watching this. There's a gap here. We've been bouncing above and below that gap. We're still close to these levels here, but as of Thursday, on a closing basis, this close here would be lower than this close, this close, this close, and this close. We'll see what happens on Friday. This, like all of the charts we're reviewing, also speaks to future economic expectations. Remember, we opened this segment by saying some good things happened on Thursday. Tech rallied. Since we've had some false shorter-term breath thrusts since the market peaked earlier this year, we're using a 10-day moving average here on NASDAQ 100 stocks greater than their 150-day moving average. You can see we're at oversold levels where the market has bottomed successfully in the past, telling us to keep an open mind about a bottoming process. Caveat is very, very similar level here in Q4 of 2008, just before a very, very, very sharp leg down. If you're a stock market bull, this is what you want to see. You want to see some type of sustained flip in sentiment creating a breath thrust. I don't have anything like that yet as of July 14th. NYSE weekly chart. This gap here was never filled, never revisited. It's 6.36% below the July 14th close. NYSE Composite, possible support in here as of Thursday's close. This is the daily chart. Notice, this is a big move here, a rapid move. This is a rapid move, telling us it's possible we could get a rapid move back to this line here. All hypothetical. Volume by price. Notice the bar here. The other bar that's similar is the bar up here, and now we're below this area, which is now possible resistance. From a trend perspective, looks quite a bit different than what we saw after the COVID low here. Compare the look of the market in here, price and the moving averages, relative to price and the moving averages in the present day. Very, very similar concepts here. NYSE advanced decline line. This is based on issues only. Last couple of rallies in the stock market, it looked a lot stronger. Right now, this is a very, very weak look in here. We had a fast move in this direction. Support comes in this area here, possible support. If you're a stock market bull on all of these charts, what you really want to see is you want this to break this trend line here. That would be step one. Haven't even done that yet. Remember back in here, you can see this huge gap in the S&P 500, another huge gap in the S&P 500. That was the inverse breath thrust that we covered in a previous video. The average and median decline, maximum drawdown after similar thrusts in history is down in this area here near 3,000 on the S&P 500. Notice, based on the current drawdown, we haven't hit any of these lines relative to the somewhat limited and very, very dated historical cases. You may remember in early May we covered the signal. It was pretty rare for the S&P 500 to finish the month of April down 5% or more year to date. The additional maximum drawdown in the historical cases, the average and median, would take you right into the meat of this area here that we've been watching. Let's call it the September, October, November 2020 cluster of possible support. And this level right in here, that's basically where the NASDAQ is today. The NASDAQ is right in this general area here, which is all the way back to the gap up from November of 2020. This point here is similar to this point in here. This is the first gap up here. Chart we've also covered in the past before, S&P 500. This is maximum additional drawdowns after a 20% decline on a closing basis. Average and median decline down here. The average recessionary bear market looking back a century, all the way down a little bit above 2,800 hypothetically. If we were to bottom right here, it would be one of the shallowest drawdowns in history following the 20% drop. S&P 500 monthly going all the way back to 1972. This is the exponential 8-month moving average in blue, the 9-month in red. We have a bearish cross here. You can't see it, but you don't need to see it. Cross in this general area, cross in this general area, cross in this general area here. This is the 7-month rate of change. The NASDAQ peaked roughly 7 months ago. The S&P 500 roughly 6 months ago. You can see the 7-month rate of change in the present day is down here, a little bit larger than 20%. The last time we were down there, right before the big plunge or during the big plunge in Q4 of 08, right here in the dot-com bust bear market, and the market did not bottom for over a year. We're in 2001 here. Looks like Q1. We really don't go into a new bull market until the spring of 2003. Notice the huge counter-trend rallies along the way, all of them fully retraced. 1987 case we did hold, but we're not really experiencing a very rapid crash. This isn't a V crash. This is a decline, a similar decline. In this case, it took weeks. In this case, it's taken 6 months. Anything can happen at any time, including a bottom. This is one of the longer-term trend charts, one of many inputs in the CCM market model. If we were to go through all of these inputs from a trend perspective, none of them really look like they're about to turn in a positive manner. Typically, with a look like this, if we want this chart, full bore bearish, to morph into full bore bullish, most likely that's going to take some time. Sometimes the direction of 2-year yields can give some insight relative to whether or not the Fed is finished. You can see 2-year yields have been rallying since July 5th. To break out here, you can make an argument this looks like a retest, and thus far, we've held. You see a look like this, an inverted yield curve, it increases the probability of recession. This is ARKK daily as of Thursday's close. Doing some nice things here. The last intraday low occurred way back in May. So we've got a consolidation look here in a very, very key area. If you're a stock market bull, we need step number 1. We need ARK to break this trend line. Hasn't done that yet. We'd also like to see it break above 47.88-ish here relative to volume by price and hold out in this area here. Doesn't guarantee us anything, but that just gets us closer to a trend reversal. Right now, it's hard to make the argument that this look here is discernibly different from this look here or this look here, at least from a trend perspective. We failed here, and we failed in this area here. Have to be careful with this. In the present day, commodity prices have come down. But the concern would be that commodity prices are coming down because the market is now fearful of a recession. So this look here, DBC, a basket of diversified physical commodities divided by SPY, reversed on the weekly chart on June 17th. We can make an argument that this reversal at this trend line here is similar to this point in 2011 and similar to this point in 2008, July 11th, 2008. In this case, the S&P 500 did rally from July 11th. It rallied 5.31%. You can see that rally down here. But then from that point, it lost an additional 48% before bottoming. Even in this case here, you were closer to a bottom, but didn't occur for several weeks. So this helps us keep an open mind about a wide range of outcomes. It could get much, much uglier, or the bottoming process could be starting. We've already rallied from June 17th to the high following that on the 24th, 6.45%. Just good to know this. It doesn't mean this over here is always a good thing relative to a bottoming process. It can be. Good to keep in mind here. Similar look to the present day in 2011, but we know from past videos there's a major central bank pivot in Europe here saying that they would backstop a bad bank. The credit markets, high yield bonds, you can see when the S&P rallies here, this counter trend rally here, high yield bonds can make it back to the trend line here, back to the trend line here. S&P makes it back to the trend line. Credit markets do not make it back to the trend line. This is a very, very tepid look in here. We're not even close to getting back to that level. The S&P is getting back to that level. To make an argument, this is a bearish divergence. There's an easy way to fix that. Credit can just rally into this area here. That's to be determined. Hard to make an argument that this is a good look. In 2008, notice the 50-day moving average for JNK relative to IEF is below the 200-day in that Q4 2008 example. And if you look at this closely, typically the probability of bad things eventually happening increases on the S&P 500 chart down here when the 50-day finally closes below the 200-day, as it has in mid-July of 2022. This is the look during the COVID plunge. This is the look during the topping process and the correction and pullback into February of 2016. This is the pullback here in the 2011 case that we were just talking about. This is during a correction in 2010, and this is during the financial crisis. Until recently, blue has been above red. This is a small but discernible shift, something that just happened. Doesn't necessarily mean the stock market's doomed. See this point here? Market rallies, but eventually this does foreshadow this drop here. This look in here is good because no signal, no input is perfect. It's always good to keep that in mind. That's why we use a weight of the evidence approach. You may remember we've looked a lot at this cluster here in the September, October, November timeframe from 2020 where we had that big bullish rally in risk assets. So this is the bullish look here. The market needs to consolidate its gains after the COVID low, then it pushes higher. You notice black comes back, momentum is waning here, but it never drops below. Not what we have in the present day. In fact, black is below red, and red is below the center line, telling us from a probability perspective, we're in a weekly downtrend here, whereas we were in a weekly uptrend here. Week to date, as of Thursday's close, this ratio was down 3.36%. The longer it stays below this level here, the more concerning it becomes. If we can pop back into this area here, that's good for the bullish case. This is similar to that DAX chart that we covered earlier, at least conceptually. The S&P 500 bottoms in February of 2016 down here. The S&P 500 has the major COVID low in late March of 2020, right here. If we were to hit that same trend line, it implies that the market might have further to fall. SPY, as of Thursday's close on a weekly basis, underperforming XLP by 2.5%. The bullish case gets a little bit of a boost if we can break this downward sloping trend line. This ratio is clearly still in a downtrend, which is really the polar opposite of what risk on looks like. Covered this in the past. SPY breaks the long-term trend line here, step one for a probabilistic trend change. Goes on to make a lower high here relative to this high, that's step two. And then it goes on to make a lower low here, undercutting this. And then it comes back up here and retests this bearish breakdown. It's a successful bearish retest. Now we've come back up, and this looks like for now that this area here, at least for now, is acting as resistance. Right now, this is an established downtrend. We're making a series of lower lows and lower highs. If you're a bull, you want step one in here. You want to break this trend line. That would help. But you really need to break this trend line coming down here. But this would be a good step if we can get into this area here and then clear this level here. Right now, it's a little concerning that the market moved a long way after that November breakout, and the cluster that we've been talking about is all the way back here. Similar concepts here to some other charts that we've looked at. We've covered this in the past. You can see defensive staples, XLP, divided by SPY, weekly basis. You can see when we dropped rapidly here below the 200-week moving average, the S&P 500 rallied sharply after the 2016 election. Similar situation here after the COVID low. When we dropped rapidly and sharply below that 200-week moving average in red, the rally was well underway and the stock market continued to rally. I don't really have that look in the present day. In fact, you can make an argument that this look here is similar to this look here, where the stock market had quite a bit further to fall here in Q4 of 2015. Doesn't make its final low until February of 2016. Right now, on a weekly basis, this is making a higher high after clearing the 200-week moving average. This is the look that the stock market bulls want to see. We don't have it yet. Still in an uptrend here in this ratio. That's a bearish uptrend for risk assets relative to all these charts. Trading the chart in front of us. We're not making any assumptions about what happens next. Let's take the same ratio. This is weekly. Now we're looking at the monthly. Covered this in the past. This is the 50-month moving average turning up here in 2008. We go on to make a higher high relative to this high as the 50-month is turning up. You can make an argument that we've got a similar look in the present day. And it's really fair to say this. This look here looks different relative to anything that we've seen since Q4 of 2016. So right now we have the ratio above an upward sloping 50-month. Of course, it's only July 14th. Long way to go till month end, so you have to make that caveat well known here. Always important to acknowledge that some good things are happening. Helps us keep an open mind. And we also need to keep in mind, the market can look good here literally for months, weeks on end. This is a counter trend move. Right here, this is several weeks. All of that can occur within the context of a downtrend. Hence, the weight of the evidence approach on multiple time frames. So let's revisit the charts from last week's video. These are the historical cases here that are similar to the present day. This is what we want out here. This type of return in the S&P 500. This is the type of drawdown that we want to avoid by jumping the gun prematurely. As we covered in detail last week, this is the type of transition that we want, the 1962 case. The 1962 case is here in the table. Walking through the other cases, this is what we want to avoid in here, kind of the fake counter trend move, the false rally. This is what we want to embrace. We'll avoid the false move. Some good things are happening. This is the look that we want to embrace. Look at the moving averages. 2002 case. This is the type of look or rally that we want to be cautious with, Eventually, notice we get the convergence and the turn and the transition to the full-bore bullish look. Similar situation here, 2008, 2009. The bear market starts here, the 20% decline. This is what a fake or false rally, false dawn looks like. Still jumping the gun here on a very sharp rally in Q4 of '08, and then you make a much lower low. This is the look that we want to embrace. Thus, the million-dollar question is, how much progress have stocks made in attempting to form a lasting bottom? Let's start with this chart here. I think we can all agree that this is the type of transition that we're looking for. Over here, we have blue, the fastest moving average on the bottom, teal, the slowest moving average on the top. All of the slopes are down and price is below. And over here, we're close to a full-bore bullish look. Blue, the fastest moving average, is on top. Teal is almost on the bottom, so we can see or visualize the transition. So this is a pretty good looking chart. And this chart is dated Friday, July 15th at 1:27 p.m. What is this chart? It's the chart of SH, or the inverse S&P 500 ETF. It's still in an uptrend over here. If you're a stock market bull, you'd prefer to see price SH get down into this area here. But right now, this looks like a counter trend move within the context of this uptrend here. So from a probability perspective, this chart, pretty attractive. How about bonds? If we want interest rates to calm down, the chart of IEF, 7 to 10 year treasuries in the ETF world, we'd really like to see it take on a look like this, because if IEF rises, that means interest rates are coming down. So does IEF look better, worse, or about the same relative to this chart here? The answer during Friday's session at 1:36 p.m. is quite a bit worse. The CCM score in this case during Friday's session, we can only check about 9% of the bullish boxes. And what that tells us is, right now, this looks more like a counter-trend rally within the context of an existing downtrend relative to a successful bottoming process. Said another way, this chart has a lot of work to do, and we really don't have a lot of evidence in hand telling us that interest rates have peaked. And thus, we really don't have a lot of evidence in hand telling us that market participants believe inflation has peaked. This chart also looks pretty good. IEF relative to SPY. So if we're at a major bottom in the stock market, this is what we want the chart of SPY divided by IEF to look like. We want stocks to start outperforming bonds. That's not what we have. So we have defensive IEF looking good relative to stocks, and we have defensive or bearish SH looking good. How does this chart look relative to the S&P 500 in isolation? And how does the S&P 500's chart look relative to this chart? Keeping in mind, this is the type of look that we want to embrace. During Friday's session, we really don't have anything like that. We've made a little bit of progress, but teal, the slowest moving average, is on the top up here. The slope is rolling over. And just recently, blue, the fastest moving average, was on the bottom. The slopes of all of the moving averages are down for the most part. So this is somewhat of a positive, a 1 to 2 month base. So we just saw that the score of IEF is about 9%. That's not very high and not very encouraging relative to interest rates and inflation. And you may remember from last week's video, the S&P 500 score a week ago was almost 0. We could check less than 1% of the bullish boxes. We've got a strong rally on Friday. This is when the S&P 500 was up 67 points intraday. And yet, this score has not really improved significantly. We can only check 1.35% of those boxes, telling us that this looks a lot more in its present form like a counter-trend rally within the context of a downtrend. That doesn't mean that the low is not in place. This could be the low. It's just your risk-reward here still not very favorable. Despite the negative numbers for the full week, we definitely saw some good things telling us to keep an open mind about a bottoming process this week. But we also have to keep in mind The good things happen quite a bit within the context of an existing and ongoing downtrend. Stocks were down Monday, Tuesday, Wednesday, and Thursday, so for the most part, we've had one strong session. The low, absolutely positively, may be in place, but we have very little evidence to support that. The data may evolve in a very favorable manner starting next week, but it hasn't happened yet. We have no improvement on the Fed pivot front, and yes, it's highly possible that inflation will start to come down in the second half of the year. The concern is inflation is so high, even if it drops significantly, it's still going to be well above the Fed's stated 2% target. And history tells us it may be unrealistic to expect the Fed to be cutting rates sometime in the coming months. We have a very high probability that the Fed's going to raise rates this month by an additional 75 basis points, and we haven't heard anything about the possibility of cutting rates. There's a reason why we have the expression, "don't fight the Fed." And right now, that concept is reflected in the charts and in the scores that we've covered in this week's video. We'll continue to take it day by day, and we'll make no assumptions about whether or not the low is in place. We all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.